Ever since the start of the Iran US military conflict, many investors have been asking us about the implications this will have on the markets and what portfolio actions they should take. In this short video, we will try to answer the same. Let us start by first examining the impact of past wars on the market, specifically the First and Second Gulf Wars, the 9/11 attacks, and the Russia Ukraine conflict. As these charts clearly show, wars typically first lead to a short term negative market reaction, followed by a quick recovery. And once things settle down, markets return to normalcy, with the war impact soon forgotten. This typical initial sharp negative reaction to a war allows investors to buy equity at a discount, leading to the potential for short term gains as markets recover and a better entry point for their longer term holdings. There is strong evidence to support short term gains for those that buy equities during war. However, longer term returns depend much more on the underlying market environment prior to the war, since the war impact soon fades away. This can be seen with the strong 1 year returns post the two Gulf Wars, supported by strong underlying economic growth, while 1 year returns post 9/11 and Russia Ukraine were more subdued. Importantly, the narrative of gold being a good hedge against uncertainty clearly does not hold up in past incidents, with no clear trends emerging of gold being either a winner or a loser during periods of conflict. While there are clear benefits of using market declines post the outbreak of war to build equity positions, investors do need to be aware that timing the bottom is virtually impossible and markets may decline more than you expect. And this narrative assumes the conflict does not spiral out of control with larger economic implications. With this background in place, let us now understand the context of the current conflict. Firstly, the vast superiority of the US and Israeli military does support the base case narrative provided by Trump that includes a relatively short term resolution to the crisis. Not only do the US and Israel spend considerably more than Iran in military spends, but they also have considerably superior technology. We will examine this base case further in the next slide, but at this point, it is fair to say that there's a high probability of this base case playing out, which could indicate that the time to buy is now. However, what does make this conflict unique, with potentially larger economic global implications, is Iran's unique geographical position, especially with relation to the Strait of Hormuz and proximity to major oil infrastructure. This introduces clear tail risk of a prolonged conflict, which can lead to further market declines and is accordingly more supportive of a staggered investment approach over a lump sum investment today. It is also important to note Iran's historical geopolitical ties with Russia and China. If either of these parties were to join the conflict, it could lead to a very substantial geopolitical escalation. However, at this time, this seems like a very low probability event, with neither Russia or China giving any indications of their potential involvement. Let us now examine both our and the market base case, which does align quite closely with Trump's vision. The first step involves a significant crippling of the Iranian military and high command, driven by the huge technological superiority of the US and Israeli armed forces. Once this is achieved, a deal is likely to emerge with an eventual puppet leadership at Iran. In this scenario, the conflict would last from a few weeks to a month, mostly with clear signs of a resolution by end April or even sooner. While there would be an impact on the global economy due to the oil supply shock, this impact can be blunted by the release of strategic reserves, rundown of inventory, a production ramp up, as well as the potential early reopening of the Strait of Hormuz. A key element around Trump's action lies around the fact that tail risks appear to be manageable, driven by the sheer level of military superiority, as well as a hope that Iran and allies' self preservation instincts would prevail and avoid doomsday scenarios. At this point, the base case does indeed seem to be unfolding, with firstly, US and Israel already having caused substantial damage to the Iranian military and high command. Secondly, most Iranian attacks have so far been successfully intercepted. and Iran has provided various indications of a willingness to indicate. As of now, chances of a near term resolution within the March April period do appear to be high, which is supportive of buying today. However, the tail risks are real and not immaterial. These very real and substantial tail risks arise from Iran's unique geographical position. Firstly, with relation to the Strait of Hormuz. This 39-kilometer strait is considered to be the world's most critical oil choke point and handles 20% of global oil and 33% of global LNG supply, with no credible alternative existing. Very importantly, even if Iran's military is decimated, they can technically still block the strait using drones, mines, and fast boats. In the absence of a deal, the US may need to secure the Iranian coast along the strait with actual feet on the ground to truly secure this critical choke point. The second major risk is that some of the world's largest oil infrastructure lies just across the Gulf and within reach of drones and short to medium range missiles from Iran. A limited strike is often manageable, with production recovering in a few weeks or a month. However, if Iran is successful in a major strike with substantial damage on one of the major oil facilities, a multi year supply shock and higher oil prices cannot be ruled out. If this disruption to 20% of global oil and 33% of global LNG sustains, it poses a substantial challenge to the global economy. Oil and gas remains foundational inputs across most sectors of the global economy, and a prolonged conflict that disrupts energy markets would disrupt supply chains, substantially increase inflation, raise input costs, compress margins, weaken consumer purchasing power, and more. The economic and market impact of a long oil supply shock can be very substantial, and it is important to not underestimate the impact of a prolonged disruption in the oil supply chain. Coming to India, we are unfortunately amongst the worst impacted countries, with 25 to 30% of our natural gas and crude requirements and 54% of our LPG requirements dependent on the Strait of Hormuz. There are likely to be substantial disruptions across non priority sectors, with temporary closures of restaurants and ceramic plants already in place. Additionally, every $10 per barrel increase in oil prices leads to a $15 billion increase in our trade deficit and increases inflation by 24 basis points. To conclude, don't underestimate the potential impact of this conflict. While most indicators appear supportive of an early resolution, there is a high probability that this conflict is resolved soon and markets see a rapid bounce back. However, it is important to not underestimate both the probability and the impact of a prolonged conflict and closures to the Strait of Hormuz continuing beyond April. In this case, further market declines are likely. Keeping this in mind, this is what we recommend investors to do. Firstly, don't exit existing investments. The base case points towards a short term resolution. The recovery can be very rapid, and getting back in can prove to be challenging. In terms of new investments, we actually favor staggering over a 3 to 6 month period. While this is a more conservative approach than buying lump sum today, and it could lead to your missing the opportunities if markets recover rapidly. This approach helps protect against the risk of a more prolonged crisis. Further, with markets having declined less than 10%, the current decline doesn't necessarily completely factor in the fairly substantial tail risk. More aggressive investors can, however, to choose to invest in a lump sum. The base case does indicate a near term solution, and with markets having already corrected, the opportunity may not sustain. However, it is important that investors seeking to deploy more aggressively are conscious of the tail risk involved and that they may be buying early and see further downsides. I hope this helps provide some clarity on the current situation. Please do connect with your IME dedicated private banker if you would like to explore this in further detail.